Today we're going to talk about taxes, subsidies and tradable permits, also known as market-based instruments or incentive-conform instruments. This is where we are in the sequence. It's week 8 already. Next week we're also going to talk more about taxes, particularly taxes. And then we're going to change gears altogether. I'm going to start to talk about environmental taxes. So what is an emissions tax, or what is an environmental tax? You pay a charge or a levy or a penalty or a fee, or depending on the jurisdiction that you're in and what terms are politically allowable or forbidden, it's called differently. Also there's legal differences between these things, but it's mostly politics that drives what is going on. But you pay something for every unit of the offending material consumed, produced or emitted, right? Obviously we would like to tax emissions because that is what we are concerned about, but sometimes you can't, and you put a tax on either the production process or the consumption of the good in question. So that is fairly simple from an economic perspective. From a political perspective, from a legal perspective, it may be more complicated, but economically it's quite simple. Now, what does that do? Previously, I believe in week 3, we looked at cost-benefit analysis of environmental policy. What we had was that there's marginal private gains from emissions, or rather from the emitting activity. And we said that these are falling as you emit more and more and more. If you're talking, say, about the sulfur or the carbon dioxide that comes out of electricity production, or electricity generation, I should say. At one point you stop using electricity because your laptop is fully charged, all the lights in your house are on, your battery, your mobile phone is fully charged, your TV is on, your microwave is on, and you simply do not have the capacity to use more electricity, right? And of course all that costs money, so you actually don't have everything on at the same time, right? So at a certain point you stop using electricity, and therefore you also stop adding to the emissions that come out of the generation of electricity. And that is this point here, Q prime. We also discussed the marginal social losses from these emissions, and we said, well, they are increasing, right? If there's no emissions, there's probably no costs, but the higher the emissions, the greater the environmental damage. And then we said that in a cost-benefit analysis, you want to maximize net present welfare. You want to set emissions at Q star, right? That is what we did in the lecture on cost-benefit analysis. Now let's introduce a tax here. Essentially, what you do if you introduce a tax on emissions, then for every unit that you emit, you have to pay as a producer, right? And that means that the marginal private gains go from this line here to this line here. It simply becomes costly to emit, right? Essentially your costs of this activity go up. And as a result, your emissions go down from Q prime to Q double prime, right? And there really is not much more to say about taxes than this, right? You impose a tax, your emissions go down simply because emissions have now become a cost. They used to be free. Of course, you needed to pay for electricity, but not for the emissions that came from the electricity. Now you pay for your electricity, the cost of generating electricity and transporting and transforming and so on and so forth, as well as for the emissions that come out, right? So you would use less. So this is the effect of an environmental tax We also talked about PIGU taxes, and the PIGU tax is here in yellow. If you set the tax exactly equal to the marginal social losses from the emissions, then you don't just reduce emissions, but you reduce emissions to the point where you reach the Pareto optimum, right? So this is an environmental tax. This is the PIGU tax, right? And there's only one PIGU tax. It can be, environmental taxes can be anything. The PIGU tax can be only one thing, right? Typically, we don't really know what the PIGU tax should be, so we impose environmental taxes rather than PIGU taxes. You would find in the justification by your government that they call it a PIGU tax, but it's actually not necessarily the PIGU tax. Typically, we have an environmental tax. And really, until we start talking about the difference between taxes and tradable, and between the difference between taxes and subsidies and taxes and tradable permits, there isn't a whole lot more I can say about environmental taxes, right? It is as simple as this. Environmental taxes have become more popular. This particular tax has been called the most popular tax in Europe and increasingly also the most popular tax in the world. And this is the plastic bag levy that was introduced in Ireland, the Republic, in the year 2002. And in that year, Noel Dempsey introduced a 15 cents levy on every plastic bag that you would get in the supermarket or in the butchers or in whatever shop you went to, right? This was done against the will of the people. There was a survey of the willingness to pay, contingent valuation, done a few years before, in the year 2000, about how much the people of Ireland would be willing to pay for such a plastic bag levy. Here you see the numbers. 1 or 2 pennies, 3 or 5 pennies, 6 pennies. This was the year 2000, right? So there was still the Irish pound there, translated here into the euro cents. And the highest 6 pennies was almost half, slightly more than half of the 15 cents that was actually introduced. But only 8% of the people in the Republic wanted to pay this much, right? 40% didn't want to pay anything. The majority was around, what is it, a fifth of the levy that was actually introduced. The reason that the minister did this was very simple. This was a period of austerity in Ireland, so the government needed extra money. The good thing about this plastic bag levy was that it's not a tax that was paid to the Department of Finance, but this was a levy that was paid to the Department of the Environment. So this essentially meant an independent income stream for the Minister of the Environment, right? And that is why he was happy to do so, and why he said it much higher than the popular will would bear, at least in anticipation, so that he did not have to negotiate with the Minister of Finance, who was of course much more powerful in government than the Minister of the Environment, right? So it's simply astute political maneuvering. That is why this tax was introduced. The initial revenue was around 13 million euros. The fixed cost of setting up the system, that is setting up the computer system and the monitoring system and the enforcement system and everything, was around 1.2 million. There was an awareness campaign of why do we do this, that cost a total of 360,000, and then the variable cost of the whole system was only 350,000. So from a government's perspective, this is a good thing, right? Because they brought in money. So you immediately see the attraction to Minister Dempsey for doing this, right? He essentially got 10 million euro richer. Ireland is a fairly small country, so this is a decent sum of money. The reason that the variable cost is only 350,000, this is essentially two civil servants monitoring, maybe two civil servants monitoring the system, right? Is because, as I said last week, this was levied in the same system that charges VAT, that charges excises, and so on and so forth. So it really was a matter of adding a few lines to existing computer code to raise this money, right? So from a government's perspective, it was a great thing, right? From an environmental perspective, this was also a good thing. So they do these regular surveys where they send people out and look at how much litter do you see in the landscape. Areas where there was no plastic litter whatsoever increased by 21%. Areas with little litter increased by 56%, right? So fewer plastic bags, less litter in the landscape. So that's a good thing. Plastic in household waste. So some of these bags were dumped, right? And some of them were put into the bin. The plastic in household waste fell from 5% contents, I think this was by weight, to 0.2%, right? So that's also a very dramatic decline. If you wonder how would they know this, well, occasionally somebody goes through your bin, right? And counts all the stuff that you put in your bin. They don't do this every week, but they do it sort of on a sampling basis, right? Retailers were happy too, because essentially the alternatives, essentially paper bags, were less expensive than plastic bags, so retailers did not complain, and the public accepted this as well. This was done after the tax was introduced in 2003. The earlier result I showed was from 2000, before the tax was introduced. Positive impact, negative impact, neutral impact at checkout. People didn't really care, right? It doesn't matter whether you stick your thing in a plastic bag or in a paper bag, or whether you bring your bag from home, right? Convenience, people didn't really care. Expense, people didn't really care. But people really, really appreciated the environmental impact, right? If you ask the average Irish punter, then this was the main benefit of this particular system. So, altogether, very positive effects, right? Nobody really complained. And that is why it's called the most popular tax in Europe and nowadays the world. And because of this, other countries started adopting the tax that was done in Ireland. This is entirely unfair. As a matter of fact, Denmark had a plastic bag levy before Ireland did, but Ireland had a very prominent environmental economist who was traveling the world promoting the success of the Irish tax, and therefore everybody copied Ireland rather than Denmark, right? But the Danes did it first. So Wales followed in 2010. Plastic bag use fell by 71%. That is single use, 57% overall plastic bags. So again, a large environmental success. The money collected from the Welsh plastic bag tax did not go to the government, but the deal in the United Kingdom, in Wales first, was that the supermarkets who were collecting this tax would donate this money to charity. Right? I think I said this last week, maybe the week before, it must have been the week before, in the seminar as well. The first few years, journalists were actually looking at supermarkets, whether they actually donated the money. and they did, right? The money donated to good causes was roundabout in Wales alone 20 million pounds per year, right? No, 20 million pounds over the 4-year period. Wales is not that big either, right? After that, because there was no scandal, right, journalists lost interest, right? So we don't know whether this is still the case, but supermarkets still say they do. So things went well in Wales, right? Huge environmental benefit. Charities were happy. So Scotland followed in 2014, England in 2015, and other countries did this as well. South Africa, all over Europe, and so on and so forth, followed this particular example, right? So environmental taxes can work and can actually be popular. More popular, though, are environmental subsidies. And the reason for that is very simple. Most people are much happier getting a subsidy from the government than having to pay a tax to the government, right? Of course, those subsidies are financed from taxes, but people don't make this connection in their heads. So with an environmental tax, you pay a charge or a levy or a penalty for every unit consumed, produced, or emitted. With subsidies, you get a premium for every unit not consumed, not produced, or not emitted, right? So a tax or a subsidy is just a negative tax, essentially. What is the effect of subsidies in the short run? So I showed you this diagram. These are the marginal private gains unregulated. This is with an emissions tax. And essentially, the mechanism here is that if you emit less, if you reduce your emissions, your tax bill goes down. So that is good for you, so that's why you do it. You move from Q prime to Q double prime. Vice versa, if you increase your emissions, you pay more tax. So you don't want to move away from Q prime because that costs more money. That is for a tax, right? Now, what happens if you have a subsidy? The effect is the same, because if you have a subsidy, if you reduce your emissions, you increase the subsidy that you get, and that increases your income, right? Similarly, if you increase your emissions, you forego the subsidy that you would have gotten, right? And that again is bad for your income. So at the margin, taxes and subsidies are the same and have therefore the same effect on the environment. And the way to understand this is that there is a double negative here, right? So with a tax, you give money. With a subsidy, you get money. So that is the first negative. A tax is a negative subsidy. But with a subsidy, you forego the subsidy if you increase your emissions rather than pay less tax. So that is the second negative. And at the margin, because you have this double negative, taxes and subsidies are the same, have the same effect for the environment, right? Emissions, if the tax and the subsidy are the same amount, emissions fall from Q prime to Q double prime. So taxes and subsidies have the same effect in the short run. Taxes and subsidies, both, if everybody pays the same tax, then the costs at the margin change in the same way for everybody. and this ensures cost effectiveness, and I'll get back to that. What is the difference between taxes and subsidies in the long run? We looked at this particular graph. Here we have your total private gains, so not just the marginal but the total, right? We said, well, this was the point where you maximize your welfare, right? Where you sort of balance the gains from using electricity with the costs of using electricity, which is how much you pay for electricity. That's 30p per kilowatt hour nowadays, I think. So this is the optimal point. If you look at the total, which of course is equivalent to the point where your marginal private gains go through zero, right? So Q prime is the unregulated optimal amount of emissions. In the long run, we are actually not interested in what's happening to the marginal, but we're much more interested in what's happening to the average costs, or the average private gains. And if we take this line and we divide it by the amount of emissions, we get to the dotted line. These are your average private gains from emissions, or from the emitting activity. Right, so that's your average private gains. Now if we introduce a tax, we do away with the marginal for now, just to make the graph more readable. Essentially what happens is that you give money to the government depending on how much you emit, right? So that is bad for your wallet, right? That is bad for the bottom line. So your average private gains fall with a tax. But with a subsidy, the government gives you money. So your average private gains increase. So the effect of taxes and subsidies on the margin is the same because of the double negative with subsidies. But on average, they have the opposite effect. Right? Now, what does this imply? If we're not looking at your short-term behavior, and then we should look at the margins, but we're looking at your long-term behavior, and in economics the difference between the long-term and the short-term is that in the short-term your capital stock is fixed, in the long-term it's not. If your average gains fall, then your return on investment goes down. And that means you invest less, right? If your average gains go up, then your return on investment has increased too, and that means you invest more, right? So in the long run, a tax reduces investment in the polluting sector, and therefore you have less pollution in the future because this economic activity shrinks. With a subsidy, your returns on investment increase, and therefore you invest more in the polluting sector, and therefore your pollution increases relative to where it otherwise would have been without the subsidy, right? So taxes deter investment in the offending sector, subsidies attract investment into the offending sector. So taxes and subsidies have the same effect in the short run, but the opposite effect in the long run, right? Go ahead.
Don't subsidies have a negative impact in the long run though, because in the slope it's still negative, but just less negative than taxes?
It's comparative static, right? It is taxes compared to subsidies. Subsidies would still reduce emissions, but emissions would be higher than they would have been without a subsidy, and definitely higher than they would have been had you introduced a tax, right? I'm not saying this is the evolution over time. I'm saying this is if you compare the situation with subsidies to the situation without subsidies. Right? So taxes and subsidies, same in the short run, opposite in the long run. Right? Important to keep that in mind. Now, taxes and subsidies obviously have different budgetary implications. A tax brings money to the government. A subsidy takes money away from the government, right? So you obviously have an issue there. The distributional effects may be very different too. Taxes take away money from the people, right? And typically that is not done evenly. And we talked a little bit about this before, that most environmental pollution comes out of energy and agriculture. That is, it comes out of necessary goods and services. And if you make necessary goods more expensive, then the people who use most of necessary goods relative to their income, as the poor people, they get hit the hardest, right? So a tax typically has a negative effect on the income distribution, an environmental tax. Subsidies have different effects, and it depends really on how you structure the subsidy. A lot of subsidies given for environmental protection are given to companies, right? And then it would benefit the shareholders of those companies. And those are typically the richer parts of society. It's not that companies are necessarily all privately owned, right? That is not the issue. The issue is that a lot of companies are owned by pension funds, right? And you guys don't have a pension fund, right? I do. So any subsidy that benefits companies benefits somebody like me more than it benefits somebody like you, right? Your parents would benefit, but not you, and they may transfer the money to you, but that is a completely different story, right? Another way in which subsidies affect the income distribution, subsidies that are directly given to households are typically given in the form of co-financing. So if we take the subsidies on solar panels or the subsidies on biofuel heating systems, they are co-financed, right? So if you want to put solar panels on your roof, then that would set you back 10, 15,000 pounds, and then the government picks up 3,000 or 4,000 of that, right? Which means that you have to cough up, what is it, 6 to 12,000, right? That is something that the middle class can do. It's not something that the poorest segments of society can do, because they simply do not have that sort of money in their bank accounts, right? Similarly, if you give a subsidy for solar panels, then obviously this goes to people who own a roof, right? That is people who live in sizable detached houses in the countryside more than people who live in smaller houses because they have smaller roofs, and definitely not to people who rent, right? So subsidies are, you may think, well, subsidies, we can subsidize the poor much, and it would be better to subsidize the poor, but typically the way we structure environmental subsidies, it either goes to shareholders or it goes to the middle class and higher, right? Agricultural subsidies typically go to large landowners like the Prince of Wales, for instance, who is the largest recipient of agricultural subsidies in this country. Okay, that's subsidies, that's taxes versus subsidies. Let's now look at tradable permits. That's the third instrument. I'm going way too fast, guys, which is good. So what happens with tradable permits is that the government sets an overall target on consumption, production, or emissions, right? And then it says, well, we are allowed to emit 100 million tons of sulfur this year. We cut it up into, did I say 100 million? We cut it up to 100 million permits to emit 1 ton, right? That's the same. And then we're gonna give those permits, or we're gonna somehow get these permits to the people who actually emit sulfur, and that is how much they are allowed to emit, right? So company A gets 30 million permits, company B gets 20 million permits, and so on and so forth, right? So far, this is direct regulation, right? Government sets an overall standard, and then it sort of like carves up this standard and gives it to every individual polluter. But then the market kicks in, and the government allows different companies, the regulated companies, to trade with one another. And if company A thinks it has too many permits, it can sell them to company B, who thinks they have too few permits, right? Provided that they can agree on a price. So that is how tradable permits work. Graphically, it works something as follows. So on the vertical axis, we have the marginal cost of emission reduction. On the horizontal axis, we have emission reduction. If you don't have to reduce your emissions, your costs are 0. We have two firms, firm 1 and firm 2. In firm 2, it is cheap to reduce emissions. In firm 1, it is expensive to reduce emissions, right? So one thing the government could do is give both companies the same emission reduction target. Q1 is equal to Q2. That is here, and then company 1 would pay a lot, P1, company 2 would pay less, would pay P2, right? So this is another illustration of that if you have sort of direct regulation, that you impose the same standard on everybody, you have different costs at the margin, and you break the Baumol criterion of cost effectiveness, right? So this is your starting point of the market, right? Now, what happens in the market is that company 2 says, well, actually it is relatively cheap for me to cut my emissions, so I'm going to do a little bit more. In return, company 1 can do less, and because of the cost difference, right, if company 1 does a little bit more, this is its willingness to accept compensation for doing more. This is the willingness to pay of company 1. Am I doing this right? No, yeah, I'm doing it completely wrong. This is the willingness to accept compensation of company 2 to accept a more stringent target, right? This is the willingness to pay for company 1 to obtain a less stringent target, right? And this mutually advantageous deal, because this one is higher than this one, continues and continues and continues. Company 2 moves to the right, company 1 moves to the left, until their marginal abatement costs are equal, right? Until the point where the price, the marginal cost of company 1 is equal to the marginal cost of company 2. And of course, you need to match this particular constraint, namely that company 2 moves as far to the right in the graph as company 1 moves to the left in the graph, right? That is how tradable permits would work if there's 2 companies, right? You can also do this with n companies, but then you can't put it in a graph, right? Now, if we get a perfect permit market, then all producers pay the same price, because that's the definition of a perfect market, right? The price is uniform, and the marginal cost of production increase uniformly. That is, we satisfy the cost effectiveness criterion. And I'll come back to that after the break, I think. Important thing here to realize is that taxes and tradable permits are equivalent if the regulator knows all marginal abatement costs, right? So let's go back to the graph. Regulator can do various things, right? It can impose this particular standard on both, or it can have a bespoke standard for the 2 companies, Q1 and Q2, right? Government can impose this particular tax, right? P1 equal to P prime 1 equal to P prime 2. And it can do either or, right? And the government would get this perfectly right. I mean, this would be an equivalent government action if it knows the slope of the 2 curves. Once you know that, you can say, well, I'm going to impose this particular tax, or I'm going to impose this particular 2 standards, and the result would be identical, right? If the government does not know the slope of the 2 curves, then it cannot do this, right? In order to find the tax that is equivalent to the standards that you give, the emission cap that you impose on all firms in your economy, you can only do this if you know your economy in great detail, right? If you know the marginal abatement cost curves of all companies. So taxes and tradable permits are equivalent if you have an omniscient regulator, right? And regulators rarely know everything. So let's look at a particularly prominent and popular example of tradable permits. This was introduced in 1990, or legislation was passed in 1990, as who was president in 1990? I forget. It was a Republican, right? Was this Reagan or Bush? Well, it doesn't matter. Anyway, the Clean Air Act goes back to Nixon and was amended in 1990, I think, under a Republican president. And what it did was, it was passed in 1990, it started biting in 1995. And initially, in the first 4 years, only the dirtiest 263 power generators had a cap on their sulfur emissions. Those 263 were responsible for about 22% of the input and 70% of the output of electricity in the United States. After 1990, the market expanded to include more and more power generators. You introduce a permit to emit sulfur, which implies that you have to monitor how much sulfur comes out of the smokestack, right? because now these permits are legal property, so you can no longer take a stab at it and say, well, I emit roughly. No, because you're going to try and sell these things, right? So you need to know how much sulfur you emit. So previously, sulfur emissions were derived from the amount of coal that you stuck into your power generator, and that is closely monitored because you pay for that, right? But then the sulfur content of the coal that you stick in varies greatly depending on the quality of the coal and where you get it from, and so on and so forth, and no lump of coal is exactly the same as another lump of coal, right? So previously, sulfur emissions were imputed from the amount of coal burned times sort of a sampling of the sulfur content of that coal. People had to switch to exact monitoring of sulfur emissions at a cost of $124,000 per smokestack per year, right? So this is not cheap, right? These 263 units can freely trade their permits. They can also bank their permits. So essentially the way this works is that in the year 1995 you emitted, say, 27 million tons of sulfur. Then you have to surrender 27 million permits to emit 1 ton of sulfur, right? That's how it works. But you can also bank your permits if you do not have 27 million permits, but you have 28 million permits. Then you can sell the excess 1 million on the market, but you can also say, I'm going to save it for 1996 or for 1997, right? That is perfectly allowed. That is called banking. What is not allowed is borrowing. You cannot say, well, in 1995 I emitted 27 million tons. I'm going to surrender 26 million permits, and I'm going to promise to surrender 1 million additional permits from 1996, from next year. And the reason that you cannot borrow is because we cannot time travel, right? So this would just like stock up the problem for the future, and there's no way we can enforce this in the future, right? So that is, well, it's much, much more difficult to enforce things in the future than in the present. So that is why you can save your permits, you can bank your permits for next year, but you can't borrow permits from next year, right? So that is how it was roughly set up. This is what happened to the sulfur emissions in phase 1. This black line are the actual emissions of sulfur in these 263 dirtiest units. And you see a steep decline, right? This is the EPA's best guess of what emissions would have been. And you see that we're far below the forecast. This is a later forecast. And you also see that we're far below that, right? So in that sense, it seems to have worked. It was good for the environment. The actual limits kicked in only in 1995. And this is how much they were allowed to emit. And this is what they emitted. Far below the allowance, right? So this is anticipation. I just told you that they were allowed to bank their permits. And that is what they did, right? This is what they were allowed to do. This is what they did. So they saved a lot of permits, apparently in anticipation of the more stringent limits that were announced for the year 2000 and later, right? So companies responded rationally in saying, well, these regulations are becoming more strict in the future, so I'm going to prepare for that and I'm going to save this. Actually, you see also what seems to be a reduction in emissions just in anticipation of the regulations, right? The reason for this is that permits were partly grandfathered or grandparented. That is complete nonsense what I say. There was no direct economic gain through the emission permit market that would explain this. But companies in preparation for this thing seem to have started to cut their emissions already, sort of as a trial and error. Can we actually do this? Forget about what I said about grandparenting. This is roughly the trading pattern. This is old stuff, so the graphics are according to the technology of 20 years ago of how to draw graphics, and a bit more than 20 years, more like 30 years ago. So the thick, black, ugly line is the allocation of permits to each of the 260, by now 420 units. The dotted lines is how much they actually emitted, right? Or how much they actually surrendered. Presumably it's the same as the amount that they emitted. If the dotted line goes above the big black line, they are net buyers of permits. If it's below, they are net sellers of permits, right? And you see that basically every company in the market either sold or bought permits, right? So it was a very lively and active market. The price evolution was also interesting. So there's all sorts of markets going on, right? The permits were auctioned, and you see the auction price here. The very first auction was in, what was it? Somewhere early 1993. And then there's futures markets and so on and so forth, and next to the spot market, that's the sales. The very early trade, the price was $300 per ton of sulfur. The first auction, the price was 140. Then the futures sort of like said it's more expensive, but then it very quickly settled on 150, and then it actually went down to below $100 per ton. So initially, people said this is going to cost us 300. That was the expectation of the market, right? But actually, the market stabilized far below that, right? So the models that were used here were very pessimistic about what it would cost, what companies could do to reduce their sulfur emissions. And that is important. And there's a couple of explanations for this. One explanation, a sort of obvious explanation, is that this was a lobbying effort, right? Now, people were desperately trying to stop this new regulation coming in by claiming it would ruin the economy and it would be very, very expensive. That is one possible explanation. The problem with this explanation is that actually, yes, lobby groups came with high cost estimates, but independent academics also had high cost estimates. So, and there was no significant difference between the lobbyists and the independent experts. So that is an implausible explanation of what happened. The more plausible explanation is that the models that were built simply did not fully reflect what companies can do, all the margins of adjustment that you can do when you're generating power to get rid of your sulfur, were simply not included in the models, and the models were overly pessimistic about what is feasible, overly pessimistic about human ingenuity. Now, this is not a course on climate, but if this were a course on climate, then it seems that this technology pessimism out of the sulfur era has sort of spilled over to the climate era, and people in the climate era seem to be overly optimistic about what you can do and what it would cost to reduce CO2 emissions. And this seems to be the wrong lesson learned. If you compare the costs of greenhouse gas emission reduction in models to the actual cost of greenhouse gas emission, then it seems that the models are overly optimistic. And it seems that the pendulum has swung. But for sulfur, this seems to be the case. Another thing happened. These are the supply and demand curves of the first three auctions, 93, 94, 95. And this is a remarkable set of graphs. So, I always get this wrong. What do we have here? So we have price on this axis, we have quantity on this axis. Price is low, quantity is high. So this is the demand curve, right? And this is the supply curve, right? Now, if you look at 1993, you actually see that the demand curve is actually very pronounced, right? You see very different bids in this market. And same for the supply curve. You also see that different companies bid on different prices. It's true in 1993, true in 1994. If you look at the demand and the supply curve in 1995, they're essentially flat, right? The demand curve is flat, the supply curve is flat if you twist your head, right? It essentially is an asymptote. That is, in 1993 and in 1994, markets, buyers and sellers in the market did not know what the price would be, right? There was a great diversity in different market agents about what the price would be. That had completely disappeared by 1995. Everybody who participated in this auction knew exactly what the price would be, right? The uncertainty about how this market behaved disappeared within 2 years. This is a perfect information, right? Everybody bids the same price. So at first there was a large spread in bids. Buyers were uncertain about the price, sellers too. Disappeared within 2 years. This was a very unfortunate result for everybody who was making money off this market. That is the consultants who were advising companies on how to bid in this market, either on the supply or the demand side. Also very unfortunate for the brokers, right? Brokers essentially sell information, just as consultants do. They all evaporated, right? Because all the people who were trading, all the companies who were trading in this market knew exactly what the price would be. So you did not need to hire a consultant to tell you what the price would be. And you did not need to engage an expensive broker to make this deal for you, because you knew how to do it, right? And we've seen the same in the carbon markets, the EU ETS and the UK ETS, as well as some of the other markets, that in the first couple of years, in the sort of the 2 years running up to the system, and then the first 2 years that the market operates, sort of you have this whole ecosystem of consultants and people in banks and brokers and everything making tons of money advising companies on how to behave in this market, and then that market completely disappears because everybody knows how to trade these things anyway, and they know it probably better than the consultants and the brokers. So, cost much lower than expected. That's a plus, right? targets were met, actually targets were exceeded in the emission reduction targets were exceeded in the first couple of years. The market very quickly found its feet, right? Transaction costs fell very steeply because you did not need to hire consultants and brokers and so on and so forth. So administrative costs fell substantially as well. So this is a remarkable success, right? A remarkable success story. And because it is so successful, lots and lots of environmental regulation is now done through cap and trade systems, through tradable permit systems. Because people look at the sulfur market in the United States and say, well, this worked. I don't need to impose a tax, right? And taxes are, of course, in many jurisdictions, sort of like political suicide. So you don't need to impose a tax. You can create tradable permit. You work with the market, right? So you're nice and neoliberal, or whatever you want to put on that. You're not anti-capitalist as an environmentalist. So it works. It's politically feasible. It's socially palatable. And this particular success story explains why we now see tradable permits for all sorts of everything, including things where you wonder, really, do we want tradable permits for this? But that is where we are. This is a good point to break for 10 minutes, and then we're going to return to cost effectiveness and the difference between tradable permits and taxes. Okay. So, last week I gave you the Baumol criterion. Here's Baumol again for cost effectiveness, right? So, we have cost of emission reduction. It's a quadratic or a second order polynomial. We want to minimize the total cost of emission reduction subject to the constraint that our emission reduction M, the sum of emission reductions in every company, exceeds our target, or at least is equal to our target M, right? So in order to solve this, a constraint of optimization, so you form the Lagrangian, that is the objective function, plus the shadow price times the constraint, rewritten as inequality. You take the first partial derivative of your Lagrangian to the things that you choose, the things that you decide on. That is how much each company N should reduce its emissions M, emission reduction M, right? Not emission M. Then you find this expression here, set it equal to 0, and the first order condition for cost effectiveness is that the marginal costs are equal for all polluters. So this is what Baumol did. Now let's reformulate this and look at this particular problem where we don't have a emission constraint, but we impose a tax T on emissions. And that means that your costs fall for every unit of emission reduction, right? M is emission reduction, not emissions. So your costs now become what we had before. This is the cost of emission reduction, but for every unit that you reduce your emissions, you pay less tax T, right? Now, this is an unconstrained optimization. So if you want to minimize your costs as company N, you need to solve this particular problem. The CD Mn is beta plus gamma M minus T, right? So this component we had before. Now instead of the shadow price and the constraint, we simply have the minus T. This must equal 0. Bring T to the other side of the equation. And what we have is that for every company N, every polluter N, we have the cost of emission reduction at the margin should equal T. Right? Previously, we had that the marginal emission reduction cost should equal lambda. But it was the same for all companies because lambda does not have a subscript n, right? It's a shared constraint between companies. Now what we have is that the marginal emission reduction cost is equal to T, But if this tax is the same for all polluters, then we have that a tax automatically creates cost effectiveness, right? Automatically meets the Bow-Mole criterion. If you reduce emissions, tax fall, and so your costs of emission reduction. Now let's look at subsidies. Cost of emission reduction is still beta m 1/2 gamma m squared. So that hasn't changed, right? Because this is a matter of technology, and that doesn't magically change if you switch policy instruments. Now, if you reduce your emissions, you get a subsidy. And if that subsidy is S, and that subsidy is proportional to how much emissions you reduce, your costs fall for emission reduction by this amount here, SMN. This should appear. If you reduce emissions, subsidies increase, and so costs fall, right? Now, if we minimize this particular cost function, what we get is this thing here, but instead of a t we have an s, right? Because s, t, the same, right? So provided that everybody pays this, or everybody pays the same tax, or everybody gets the same subsidy per unit of emissions, subsidies also automatically get you to the cost-effective solution. That is, you meet your target at the lowest possible cost. And of course, if your subsidy and your tax are the same, then you get to the same solution, right? Tradable permits are a little bit more complicated. Essentially, tradable permits work as tax for permit buyers and a subsidy for permit sellers, right? So if you have too many permits and you sell them on the market at price P, your costs fall, right? This is your cost of cutting your emissions. If you cut your emissions more than you need to, then you can sell them at price P and your costs fall, right? If you're a permit buyer, right, then you need to buy permits at price P, but the fewer permits you buy at price P, the lower your costs are, right? So also for the buyers of permits, you need to subtract P times M. Now, we can solve this particular problem for every company. That is, we want to minimize total cost. We get here, we replace the T with a P, we get this thing here. And provided that the market works well, that everybody faces the same price of their permits, the market again gets you, or the market gets you automatically to the point where the marginal costs of emission reduction are the same for all polluters, right? So it doesn't matter whether you use taxes, subsidies, tradable permits, you get to a cost-effective solution. If you're smart enough as a regulator to predict this price in advance, then you can set your P equal to your T, right? Or your T equal to your P, right? If you're not smart enough, then perhaps you can't do that. Right? Unlike direct regulation, these market-based instruments get you to the cheapest way of cutting your emissions automatically, provided that you have uniform regulation, right? Uniform taxes, uniform subsidies, or a well-functioning permit market. Okay, let's contrast taxes with tradable permits. taxes reduce emissions, tradable permits reduce emissions, right? Taxes because you make emission more expensive, tradable permits because you put a cap on emissions, right? And if the cap is lower than what it otherwise would have been, you reduce emissions, right? So that is, both work the same way, right? Both equate abatement costs at the margin, so both policy interventions are cost effective. That is good. There are different ways of sort of starting the market in tradable permits. One way is that the government holds the permits and auctions them to the people who want to emit sulfur or CO2 or whatever, right? Mercury is nowadays also government regulated in this way. If that is the case, then the government gets revenue, right? Taxes, government gets revenue. If you auction permits, the government gets revenue. There's of course also other ways of getting tradable permits to the market. Often permits are given away for free to the polluters, typically based on their past performance. So what you would do is that if you start the market for tradable permits in 2025, then you would give every company who is emitting or is planning to emit or every company permits that are proportional to the amount that they emitted in 2023, right? The last year for which you had reliable data. And that is called grandparenting because it looks to the past. 2025 emission permits are based on 2023 emissions, and because you give away things for free, right? Just as grandparents do. So that is another option for getting your permits to the market. And then of course there's mixed forms and anything under the sun you can imagine. In this case, these permits do not bring in revenue, right? So in that sense, they are not equivalent to taxes from a budgetary perspective. There is, however, so taxes and tradable permits are similar in many ways, if not equivalent, but they are different in other ways. And that is that if you use taxation, you actually do not know the environmental impact, right? Unless you happen to know how the market works exactly, unless you happen to know the marginal abatement cost curves of all companies, of all polluters in your economy, you cannot with any form of certainty predict the environmental outcome. You know that emissions are going to fall, but if you don't know exactly where these cost curves lie, you can't predict the environmental impacts. Tradable permits are the opposite. You set a cap, and therefore you know exactly what the environmental consequences are. But unless you know the marginal abatement cost curves of all the companies in your economy, you do not know what the price will be, right? So taxes get you economic certainty, but environmental uncertainty. Tradable permits give you environmental certainty, but at the expense of economic uncertainty, right? And then the question becomes, and of course if you know your economy, then they are equivalent. But supposing that you do not know, which of the two is more damaging, right? Or which of the two is more valuable, economic certainty or environmental certainty? For that, we need to turn to the Weizmann theorem, named after Marty, who you see here, who was a professor at Harvard University. And he did this, he published this in 1973, and the paper is actually about the choice between a planned economy and a market economy. But its main application is actually in environmental regulation, and Marty turned to become an environmental economist much later. So we're going to return to cost-benefit analysis, and the graphs are slightly different. Here we have the quantity of emissions, here we have the price. This is the quantity of emission. Quantity of emissions, right? Must be. That's where the marginal damage cost is going, through marginal cost. This is your unregulated optimum. If you push your emissions down a little bit, it's going to cost you a little bit. If you're going to push your emissions down a lot, it's going to cost you a lot, right? So the optimum tax that you would want to impose is P star. The optimum cap that you would want to impose is Q star, right? So this is just the cost-benefit diagram again, right? We've seen this one a couple of times now. Now, these are your the true costs at the margin of reducing your emissions. But now suppose that the government made a mistake, that people in industry convinced the government that it's actually more expensive to cut emissions than it really is. And really, I pressed that button 5 times in one go. So these are the actual marginal cost of emission reductions, but the government assumes that the costs are the red line, right? The government makes a mistake, either a genuine mistake or a deliberate mistake, because they are the victims of lobbying or something. If we would use a quantity instrument in this case, the government would actually pick Q prime rather than Q star, right? Because that is where the assumed marginal cost equal the marginal damages. So my story is completely wrong, right? If emission reduction is more expensive, or is assumed to be more expensive than it really is, then actually if you use a tradable permit system, you're going to under-regulate the market. No, my story is completely consistent, right? This is what the lobbyists of industry would like you to believe, right? That it's more expensive, and therefore we should not cut emissions. We should allow for more emissions. In the very early phases of the EU ETS, this is exactly what happened. The 2 big emitters in Germany essentially cornered the market, traded permits at extremely high prices. The way they got away with this is that company A sold emissions at a high price to company B on the Monday, and on company B they sold them back at an equally high price, and they just swapped money. They just swapped, but neither company actually was out of pocket, but the market seemed very, very, very high, and the price was very, very the market was very expensive, the price was very high, and that convinced the then Merkel government that perhaps we should not be so gung-ho about emission reduction for CO2, right? So this is a plausible story. Government is convinced that the costs are higher than they really are. Now, if we look at the corresponding tax, we actually find that if you assume that the marginal costs are higher than they really are, then you would impose a higher tax on emissions. You go from P star to P prime, and that is, if you use a price instrument, you over-regulate the market, right? And now my story falls apart. If you're green and you expect that the government will use price regulation rather than quantity regulation, you should exaggerate the costs of emission reduction. And if you're in industry and you expect that there will be price regulation, then you should pretend that your costs are lower than they really are, right? So the lobbying works differently between taxes and tradable permits, right? So the symmetry between taxes and tradable permits break down in a political economy model, right? But we're not doing political economy. But it would, right? So, wrong price with prices, with taxes, wrong cap with a quantity instrument, right? Now, which of the two is more expensive, right? Which of the two cuts welfare more? If we under-regulate with a quantity instrument, we have more environmental damage than we would want to, and that amount to this, that is this amount of welfare loss, right? But in return, we actually regulate less stringently, so there's also a lower cost of emission reduction, and that is this amount here. And the welfare loss is this blue triangle, right? If we choose a tax, a price instrument, we over-regulate, so we end up in this particular part. So we have an environmental gain that is equal to this area here. But we have additional costs of emission reduction that amounts to this area here. And the welfare loss is the pink triangle that you're looking at. Now, from where you sit, the blue triangle and the pink triangle are the same size, right? So the net welfare loss is the same. There's obviously a distributional thing going on, right? A redistribution from the environment to polluters or from polluters to the environment, one of the two. But the net social loss is the same in both cases from this mistake. That's what it looks like from where you're sitting, and that is actually exactly true, right? These two triangles are exactly the same size. So far, taxes and tradable permits are still equivalent from a net social welfare perspective. But what now happens if the marginal damage cost curve is steeper than it is drawn here? Well, in that case, the blue triangle shrinks, the pink triangle grows, right? This curve is steeper than Q prime and Q star get closer together. That is, the under-regulation in quantity instruments shrink, whereas P star or P prime goes further away from P star, right? So the over-regulation with price instruments grows, right? And as a result, the blue triangle shrinks and the pink triangle grows. And the two are no longer equivalent, right? It is better if the green curve, the marginal damage cost curve, is this steep. It is better to make, or it is less bad to make a mistake with a quantity instrument than with a price instrument, right? The mistake is the same in both cases. The red curve is here rather than here. But with a quantity instrument, the consequences of your mistake are less pronounced than with a price instrument. If the marginal damage cost curve becomes shallower, the opposite effect happens. The pink triangle shrinks and the blue triangle grows. Right? Because again, Q star moves away further from Q prime, and P prime gets closer to P star because the curve is shallower. If the brown curve, the marginal cost curve, and the marginal damage curve are equally steep in absolute terms, then the welfare loss is identical, is independent of your different choice of policy instruments. Right? So this is the Weitzman theorem. And here we have Marty again. If the true marginal damage cost curve is less steep than the marginal abatement cost curve, then mistakes with price instruments, that is taxes, are less costly than our mistakes with quantity instruments, that is tradable permits. Vice versa, if the marginal damage cost curve is steeper than the marginal abatement cost curve, then mistakes with quantity instruments, tradable permits, are less costly than our mistakes with price instruments. Now, I showed this graphically. Weizmann, of course, did this with maths, right? But the maths don't add any insight, just add complications. And this is just generally true. Now, the question then, of course, becomes which of the two situations hold, right? And which policy instrument is better suited for which problem. Now, if you take a problem like climatic change, right, and I said we would not talk about it much, climate change depends on the accumulation of greenhouse gases of all countries in the world and the accumulation of greenhouse gases over decades. Right? That is what drives climate change. That means that if you are, say, the Prime Minister of the United Kingdom, typically your tenure or between elections is 4 or 5 years, right? You are responsible for 2% of emissions over a short period, a small fraction of the world, and that means that it doesn't really matter what you do with your emissions, right? Whether you cut your emissions by 1% or by 10% or by 50% in that short period that you are in power over a small economy or a mid-sized economy, you're not going to change the climate much, right? So whatever you do with your emissions, climate change will be roughly the same. And that means that the marginal damage done by climate change, by emitting an additional ton of CO2, is basically the same, right? So in that case, your marginal damage cost curve is very shallow because it doesn't really matter what you do with your emissions. Climate doesn't really respond to that, right? So then you are in this situation, and really you would want to regulate your economy, your greenhouse gas emissions, with taxation, right? Because if you put your tax too high, you're going to cut emissions by a lot, but it's not going to change the climate by much. But if you put your tax too high, then you could, if your the price of tradable permits is too high, then you could do real damage to your economy, right? So in these sort of situations, actually the economic certainty of knowing what the price will be for your tax is much more valuable than the environmental certainty that you would get from your emissions, and that is simply because your emissions, the part of the emissions that you control, simply do not matter much, right? If you are in a situation, am I going the right direction? No, I'm actually going entirely the wrong direction. If you are in a situation where the economic consequences of getting things completely wrong do not matter much, that is, you are really talking about a niche product, a product that sort of is used in a very tiny part of your economy, and you can completely eliminate it or you can let it be, the economy will do roughly as well. But your environmental damages are really dependent on these things. So we are talking about stuff like that is acutely carcinogenic, right? Or we're talking about the prevention of a pandemic or something like that, something that could really hurt your population, really hurt your environment, really hurt the health of your people. But the alternative is actually that cheap, right? Switching from CFCs to HFCs or something like that. actually a trivial amount of money, but you prevent potentially tens of millions of cases of skin cancer, then your marginal damage actually very steep. Your marginal costs are fairly flat, and then you should go for a price for a quantity instrument. Then you should have cap and trade and say, well, we're just going to cut as fast as we can, right? So it really depends on the nature of the environmental problem, whether you would want to use tradable permits or taxes, because the consequences and the uncertainty are very, very different. Right? So this is Weitzman 73. As I said, Weitzman did not write about the environment, but that is actually the main application of what has become known as the Weitzman theorem. So let's return to our criteria and just run them down quickly in the last 12 minutes. Direct regulation is unlikely to be cost effective unless the regulator knows a lot and industry is homogeneous, right? And the two are actually basically the different sides of the same coin, right? If you have a very diverse sort of polluter base, then it's very unlikely that you know what is going on. And if you have a very small or homogeneous polluter base, then as a regulator, you in principle can know what is going on. Does not necessarily mean that the regulator does know what is going on, but in principle it's knowable, right? Institutional instruments like cogent bargaining may be efficient, can be cost effective. Voluntary agreements, as I argued last week, actually make use of a lot of information about what it would cost to reduce emissions. So in principle you can sort of like get closer to the least cost solution to meeting your environmental targets, whereas taxes, subsidies, tradable permits are cost effective by design, right? Now, the example that I gave, the very simple derivation, makes two assumptions, right? One is that taxes are indeed uniform, right? And subsidies are uniform, and everybody is subject to the tradable permit market. In reality, there's a lot of exemptions there, right? So the UK ETS, the system for tradable permits for carbon dioxide and a few other greenhouse gases in the United Kingdom, only applies to installations that emit more than 10,000 tons of CO2 per year. Now, you may not know, but we have a combined heat and power plant on campus, but Sussex is a relatively small university, so we emit less than 10,000 tons tons of CO2 per year. So University of Sussex is not subject to this regulation. But Imperial College, which is a much larger university and has a much larger, well, actually it has a hospital and we don't have a hospital, right? They also have a combined heat and power plant, but they emit much more than 10,000 per year. So Imperial College pays for its CO2 emissions, but Sussex does not, right? So that is one exception. The other exception is illegal emissions, right? That sometimes people do naughty things, right? And then of course they escape. The regulation and prices are no longer uniform. Marginal costs are no longer uniform. We talked about administrative costs. Command and control typically is expensive because you tell people what to do, and that means that you need to write these regulations, and then you need to monitor what they're doing, and you need to enforce this, right? So this is expensive, which is a bad thing for the economy, but a good thing for the bureaucrats. Institutional instruments, again, a mixed bag. Some of these things are cheap if you can solve things through voluntary agreements, if you can solve things by having people negotiate between themselves in the form of cogent bargaining. That's cheap, right? Because you don't need to step in as a government. But if people start fighting about who owns what and what is really allowed and what is not allowed, then of course it can become very expensive because you need to sort it out through the courts, and that is expensive, right? Taxes and subsidies are very cheap if you make use of the existing monitoring and fiscal instruments. If you use the same system as excises and VAT, it's not very expensive. Tradable permits are more expensive because you need to set up a trading floor, you need to set up a monitoring system, and so on and so forth, right? So taxes are perhaps come out the cheapest here. Environmental effectiveness we talked about. Taxes and subsidies have an uncertain effect on the environment. Tradable permits have a certain effect on the environment. If you set a cap on emissions or a technical standard on behavior, then typically you have a certain environmental effect, right? You just know what's going to happen to the environment. But of course there's also illegal activity, but it also holds for these ones, right? That is if you set the standard on emissions. But oftentimes we do not. Oftentimes we set the standard on what goes into production rather than what comes out of production. Or we set the standard on the technology used in production. Right? And then of course you don't really know what's going to come out, right? Unless again you know exactly the production process. But if you set the standard on there's only so many tons of mercury that you can emit, fine, right? Then you have it. But if you set a standard, say, God, mercury is a bad example. There's only so much lead you can emit, right? Then that sets the environmental effects of the lead that you emitted. But if you set the standard and say there's only so many milligrams of lead per liter of paint, then of course you don't know the environmental effects because you don't know how much paint will be sold, right? You know the environmental effects per liter of paint, but you don't know how much paint, how much the demand for paint is going to change if you increase the price for paint, right? You don't know the substitution elasticities with lead-free paint, right? Lead is bad for you. It's actually very bad for your cognition. It's a big problem in older buildings. Don't know where I said this. Older buildings in the United Kingdom, actually all over the world. There used to be lots of lead in paint because it sort of like gives this nice gloss and have wonderful chemical properties. The problem is that you have then lead on your walls, and if you start licking the walls or start eating the paint, and you guys are too old to do that, but once you have young kids you will realize that this is a real issue. You get all sorts of health problems, right? So you don't want lead in paint. I'm going off on a tangent, right? These instrumental effects are again a mixed bag. Instrumental instruments. Dynamic effects, taxes and tradable permits have a continuous incentive to emit less, right? The less you emit, the lower your taxes, the less you emit, the fewer permits you need to buy, the more permits you can sell. Subsidies have the same effect in the short run, but may attract new investment, new entrants in the long run, right? Direct regulation, if you set a standard, then once your polluters meet the standard, they stop, right? If you tell a polluter you can only emit 10 million tons of sulfur this year, then they're going to cut their emissions till they meet the 10 million tons, and then there's absolutely no reason for them to go down to 9 million, right? Whereas if you have a tax, if they go to 10 million tons, that's fine. If they can go down to 9 million tons, they pay less tax, right? So there is this continuous incentive to cut emissions further and further and further and further. If you set a standard, then meet the standard and stop there, right? Why would you go further? So that is an important distinction, right? Of course, you can increase your taxes over time. You can also make your standards as more stringent over time. Flexibility, there's no real distinction between the different kinds of instruments. Typically, it's easier to make targets less stringent than it is to make targets standards more stringent. Similarly, it's easier to reduce taxes than to increase taxes, right? So that just works the same. Subsidies are easy to increase unless you consider your budget constraints of the government, right? Tradable permits here are slightly more flexible because as a regulator you can release more permits than you planned, right? You can just increase your auction if you think that your initial regulation was too stringent. But you can also decide to auction fewer permits, or you can even buy back permits and retire them without emission, right? This is not just true for the government. You guys can also do this, right? In principle, anybody can buy permits on the UK ETS market, but nothing obliges you to then actually emit the CO2. So if you don't like the target for emission reduction on greenhouse gases that the government has set, then you can lower the target by buying permits and not using them, right? So that is a good thing. Equity, I talked about, and we'll come back in week 10, the week after next. That different instruments have different distributional consequences, as I made this point already. In general, environmental policy is regressive because we focus on necessary goods such as energy and food. That implies that you have a good reason to keep the costs of emission reduction as low as possible. Because if your policy primarily hurts the poor, then you want to minimize the pain also for distributional consequences. And that argues in favor of taxes, subsidies, tradable permits, because then you minimize the economic pain and therefore you minimize the distributional consequences. Taxes and auction permits have the additional advantage that you have revenue as a government that you can use in principle to compensate the losers at the bottom end of the income distribution from your policy, right? If you have environmental policy that works through regulation, then your cost will be higher and therefore the pain will be higher, but you also don't have this revenue to compensate the losers, right? So that is an important argument in favor of taxes and tradable permits, auctioned tradable permits. That's all I wanted to say.